Investor favorite trade desk stock TTD is getting a haircut today, down around, depending on the minute, between 15 and 20%. And this follows a huge run in the stock since it IPO'd, up over 2,000%. I personally invested in it a few years ago. I'm personally up over 13x on it. It's now only a teaser position though for me. I've sold off most of the position as it rallied to what I thought was really extreme and overvalued territory. So investors are wondering, now that it's gotten this haircut following their third quarter earnings, is now the time to buy? Is this now a bargain level? Now, this is an exceptional company. You have the founder-led, profitable, taking market share. So you want to know, what do they even do? Okay, so high level, they're a platform for ad buyers where they're representing the buyers, the ad agencies, the brands themselves, where they want to figure out, hey, how do I spend this money in a attractive way, a high return on investment across lots of different types of venues? I mean, historically, you had linear TV, and that used to be a huge chunk. Radio. Well, now it's, you're looking at a lot of different options: connected TV, online advertising. And so if you believe digital advertising is going to keep growing, and you believe that more and more is going to be algorithmic or programmatic, that is how the trade desk wins. It's through this efficiency, greater return on investment for the customer, also an unbiased aspect where the trade desk doesn't own the supply, unlike someone like Google, where they own the supply. They have the supply of advertising. So, you're representing both sides. Here it is. The trade desk is just representing the buy side, the buyers that want to place these ads, to say, hey, how do we get the most bang for our buck? And historically, this model has done very well for them, not only because of the tailwind of digital ad spend, but because of these aspects of being unbiased, let's say, for their customer, or being able to pencil out, hey, we can show the very attractive return on investment. And so you can see the gross spend on their platform has gone from a couple $100 million a few years ago to over $7 billion recently. And you see the revenue growth has kept up with that, where they get a large cut of the ad spend on their platform that effectively goes to them as revenue. Historically, very profitable business. So why is the stock dropping following their third quarter results? I turned to AI Ticker Chat. First month is free. I asked, did management indicate anything about the macro? I'm hearing a lot about the macro. I can do a whole separate other video on this, because I think there have been some really negative developments recently on a macro perspective. But here it is. Let's hear what management has to say. And they're saying, yeah, we are starting to see some pressures on businesses due to macro factors. That said, look, we're still very excited about a tidal wave of opportunity, an increasing shift of connected TV to streaming, talking about a huge amount of content creation that's going to be effectively supported by advertising. So, as you think about more and more people creating low-cost content, and some people are estimating that the cost of creating content is going to drop like 90% because of generative AI. Well, how are you going to support that business model? Well, you can have a traditional Netflix type model, but more and more business models are saying, you know what, we need to lean on to advertising. And if you're going to lean into advertising, working with a company like the Trade Desk might be a key source for getting, like, hey, this platform like a Netflix, that's the supply side, but the brands might say, hey, this would be a perfect spot for us to advertise. That said, going back to the macro theme, they are seeing some cautiousness among advertisers due to macro uncertainty. That said, despite this uncertainty, they still think, even with pressures, that there will be opportunities for them to gain market share. And that's certainly what you've seen with their growth. You're looking at also weaker than expected guidance for the fourth quarter. They're talking about only 18% growth year over year. They're saying, well, last year you had some benefit from U.S. political spend. If you adjust for that, it would have been 22% year over year. It is worth calling out. They're saying, look, we estimate $580 million in revenue and approximately $270 million in EBITDA. Now, fourth quarter is a very strong advertising period, but saying $270 million in EBITDA and $580 million in revenue, it shows you the types of profit margins they could have. If they wanted to. They're clearly investing significantly in this business. It shows in the fourth quarter that their profit margins are quite attractive. The question is this now a bargain now that Trade Desk is getting a haircut? First of all, in full disclosure, this is not financial advice. By the way, you're watching Unrivaled Investing. Quick plug. Take charge of your investment journey with unrivaledinvesting.com, a low-cost weekly letter that helps you find potential multi-baggers, the types of stocks that can go up hundreds or even thousands of percent over time. So looking at the trade desk, there's a lot that's going right, despite the weak guidance, despite the macro concerns. You're seeing 25% growth in the third quarter, a reacceleration in this business. You're talking about significant outperformance. They continue to take market share. And that is one of the key signals I look for. And that's part of the reason why it's still a teaser position in my portfolio, is I want to own businesses that are unrivaled, that say, hey, we have this better business model, we have this better mousetrap, and because of this, we're going to gobble up market share each year. And that's what they're doing. When you see Google posting 10% growth and them post 25% growth, it should go, okay, more and more ad spend is going to the trade desk. That is a key data point investors should think about. Who's winning over time? What are the respective growth rates? Is it sustainable? Clearly a huge market. Addressable market heading to $1 trillion. Connected TV, management mentions this several times. Connected TV has actually been something that they've been talking about back when I first invested in the stock, which I think was around 2018. So this is clearly, and this is the part that investors should get. You can find multi-decade trends that you can ride. The question is, are you paying the right price? Are they actually executing on it? So I think they're executing. You see them taking share. I'm not really happy with how the margins have trended over the last few years. I wonder if there's been a little too much greed internally in terms of, paying themselves, because, I think their profit margins could be a lot better. There's also huge opportunity, though, not only with connected TV, also with international growth. And, as they've said before, and they've been saying for years, objectivity is our greatest asset. By aligning our interests with the buy side, not representing both sides, not having some inventory that they're trying to sell. So there's a lot that's right with the trade desk. There's a lot of opportunity. That said, management, despite seeing this opportunity, they're eager to blow out of the stock, selling, tens of millions of dollars worth of stock. So you have Jeff Green, the president, CEO, founder of the company. I personally I'm very mixed on this. I love seeing a founder that knows his stuff. He's a serial founder. He previously sold his prior company, had a very successful exit, then launched Trade Desk. When I see that, I go, okay, this guy knows how to execute. That's what I want to find. That's what I want to find with my own personal journey. I want to find companies, management teams that either have proven themselves already, or this is their second time around. This isn't their first rodeo. I can trust them. I can align with them. They have huge interests. If the stock goes down, they lose more money than I do. That's what I, want to find. Those types of situations. I don't like really seeing him blow out of the stock where he's selling tens of millions of dollars, for the last few months. So that's the part that bothers me a bit, despite knowing this opportunity. When I check in with AI Ticker Chat, again, which once again covers most of the U.S. stocks above $300 million market cap, using the AI Predict feature to get a framework for what's the growth in the years ahead, what's the profit margins, what's the multiple, where can the stock go in the years ahead. It has a pretty dim outlook for the trade desk, even though it says, look, it might grow at 20% per year going forward. It might even achieve 22% profit margins versus 7% last year and throw on a 30 times multiple, but that's just not enough and you're still down 50%. So it's really interesting. This is a little darker than my own personal perspective because I think their margins could be even higher, as they historically showed way back when. But this does not reflect a good situation, in my opinion. Now, looking at my own personal framework, thinking about the price, thinking about the upside, I'm saying 30% margin, let's say. They're growing a little bit above 20% this year, even though they're guiding to 18% in the fourth quarter. And I'm assuming that over the next 5 years, they grow 20 to 25% per year. 5 years from now, maybe trade at a 30 times multiple, maybe. In that scenario, I'm effectively saying, yeah, you need to get to 35% profit margins versus single digit last year. You need to grow at 25% per year going forward versus 18% that they're guiding to in the fourth quarter this year. And you need to have a 35 times earnings multiple 5 years from now just to get less than 100% return. And that just isn't compelling enough. So I would say, despite this haircut, you're still looking at something that is very, very expensive. I personally think you could see this stock head much lower, maybe even below $40 a share, especially if you were to see the cautionary macro signals that I'm starting to pick up play out with advertising spend. If you were to see another quarter where they say, hey, the macro's gotten worse and now it's going to impact our guidance again for, let's say, next year, then I think you see the stock reset possibly much lower. I broadly like the execution. I don't like the compensation. I don't like to see management bailing out on the stock, selling tens of millions of dollars of stock. So that I don't care for. I would rather find situations, as I called out to my subscribers at Unrivaled Investing, where it's like, hey, here's another situation that's a lot less sexy, but has still managed to outperform the S&P over a multi-decade perspective, generating thousands of percent return. And I think there's a clear line of sight to 15 to 20% plus returns over the, let's say, the next 5+ years. You know, a stock trading at like 8-9 times earnings versus something like this, where you can look at the math and assuming profit margins that they're nowhere near, you know, you're effectively saying 60-70 times earnings for a company growing at, you know, sub 20% in the fourth quarter. That just isn't compelling. So I think investors are saying, hey, quality, this is quality is great. You know, founder, great. You know, insiders that know what they're doing, great. Quality and valuation. You need to balance both. And when you overweight one, I think you end up getting burned. You have to consider all these different dynamics, the quality of the business, the valuation, and also the cash flow that's ultimately getting returned to you as a shareholder. I'm just not seeing enough, you know, attractive dynamics here. I think that there will be better bargains ahead for the patient investors. And you can see what I'm personally buying and, you know, the stocks that I think are compelling or compelling ideas at unrivaledinvesting.com. Thanks so much for tuning in. If you like this video, please make a point of hitting that thumbs up, hit that subscribe button.